Thanks for tuning in to Worldview. I'm your host, Niraj Shah. Our guest today recently wrote, and I quote in one of his newsletters, that higher for longer is undoubtedly this year's silly season theme. And he also believes that equity markets still face significant competition from the risk-free rate of 5.5% in the case of the US. At a point of time when we are atop 20,000 on the Nifty, how does he see the world of risk assets around us? It's our absolute delight to have in Christopher Wood. He's Global Head of Equity Strategy at Jefferies. Joins us right now from his Mumbai office. Chris, so good of you to take the time out. Thanks for joining us.
Very good to see you.
Yep, likewise, the feeling is entirely mutual. Chris, how do you, let me start off with the big elephant in the room. Since the last 4 years, central banks in some way or the other, or probably the most prominent way, driven what risk assets do. At this point of time, with there being a bit of an uncertainty around what will happen to inflation, stroke interest rates, how do you see central banking action and how do you see that impacting risk assets?
Well, in the case of the Federal Reserve you're talking about, yeah?
Largely.
Well, the Federal Reserve has clearly been talking tough and acting tough. They've raised rates more than anybody, I believe, would have predicted a couple of years ago, myself included. But the context of this was the huge monetary expansion committed to by the Fed in 2020 in the context of the outbreak of the pandemic. For some reason, the Federal Reserve thought that printing lots of money was a good way to address a pandemic. The result was that you got a surge in inflation for the first time really since the late 70s. The Fed did not understand that creating a lot of money supply, the biggest broad expansion of M2 growth for decades, was going to result in inflation. So the Fed was caught by surprise. So the Fed is now engaged in an exercise to try and restore its institutional credibility. And hence the Fed is very reluctant to signal an end of tightening until it sees a material weakness in the labor market. So on that point, it's interesting that the US economy has defied these recession predictions. But the one technical point to be aware of is that we had this huge monetary expansion. In the last year or two, M2 growth is collapsing, but it's collapsing from a very high base. So in terms of the pre-COVID trend, we are still above trend on M2 relative to nominal GDP ratio, although we're getting nearer and nearer trend. And if the ongoing decline continues, we should be below trend by early next year, which means the liquidity tightening will start to really impact. So what I'm really saying is too early to conclude that the US economy can avoid a downturn because of the monetary tightening, which has been ongoing.
Yeah, but you reckon that in a higher for longer scenario, if that is indeed the presumption that I guessed from your note.
Well, that's the presumption of the market for now. Absolutely.
Okay. In that presumption, can the US engineer a soft landing even if there is a downturn? And what does it mean for risk assets?
Now, the market thinks the US can engineer a soft downturn right now. So the last employment data was almost Goldilocks because it was a bit weaker, but nothing drastic. But I'm saying it's too early to conclude that. But the difference between the US equity market and the Indian equity market is, in my view, in the US, there is still a material risk of recession going into 24, as indicated by the inverted yield curve and many other factors. Credit growth has turned down in the US, same story in Europe. Whereas in India, I have no concern about a recession. So the only concern I have of India is if the US market falls is correlation.
Okay. What about the fact that dollar index seems to be strengthening, oil prices seem to be higher? Does that bother you when it comes to global risk assets and India as well?
Well, dollar index will keep strengthening so long as we're in the higher for longer mode. But my working assumption is that the moment we see some real employment market weakness, which in my view should be coming, then in my view the Fed will then be put in a situation where it has to decide between its two mandates, that is employment and inflation, assuming inflation is still above 2% year on year. And my base case, when presented with that challenge or that dilemma, my base case until proven wrong is the Fed will focus on the employment mandate, not the inflation mandate. That will then send a signal to world markets that the Fed is not going to actually really enforce that 2% target, which will then send the signal that inflation may end up being structurally higher, which will then lead to a sell-off in treasury bonds, weakness in the dollar, but that would be more positive for cyclical equities.
Okay.
Near term, though, the oil price is clearly an issue both for the Fed, the markets, and indeed for India.
Okay.
If it keeps rising here.
Yeah, and you reckon, I mean, you write about that a lot as well. You reckon that we are in a higher for longer scenario for crude oil as well?
Well, I think on oil, there's a fundamental supply constraint, which is a combination of several factors. First and foremost, we've had an ongoing attack on fossil fuels from the growing power of the green lobby in recent years, which has sent the signal to fossil fuel companies not to invest in oil exploration. So that's one fundamental reality.
Yeah.
Second, the second point is that the US shale looks like, based on what I've been told, that it's peaked out in the sense of the best areas have already been geologically exploited, which means the practical consequence is that, OPEC is now the swing producer again, or OPEC plus, I should say, most particularly Saudi. So they clearly are trying to control supply. So the key issue is really what price they're comfortable with. Maybe it's where we are today, I don't know, but they're the swing producer in the market. So unless we have a US and European, the biggest risk for oil right now is European recession triggering demand destruction. Otherwise, I think the direction of oil is up. The reason oil was weak in the first half of this year may surprise people. The common conventional wisdom is oil was weak because the Chinese economy was weak. But actually the data shows that the Chinese demand for oil is back well above pre-pandemic levels. So actually the reason the oil price was weak, in my view, in the first half of this year, was that the Biden administration continued to take oil out of the US strategic reserve, even though it said it was going to do the opposite the early beginning of this year. But this quarter, they've stopped taking the oil out, selling the oil because it's getting to very historically low levels. And that's coincided with the pickup in oil.
Okay.
But for the Fed, the problem will be if oil rises, let's say theoretically 110, 120, that is likely to cause inflation expectations to rise. Then the Fed will no longer be able to say inflation expectations are well anchored. And then we do have a risk of oil forcing another Fed rate hike. So in that environment, everything sells off, stocks and bonds globally, except oil stocks. That's why I continue to advise investors to have some energy stocks as a hedge.
Yeah, most certainly. So in effect, Chris, if indeed there is a bit of a slowdown around the world, that might actually be good for risk assets because the Fed will focus on employment. Slowdown means oil prices also come off, which is great for economies like India. You think that would be the better of the two outcomes?
No, for emerging market equities, without a doubt.
Without a doubt.
For emerging market equities, given the sensitivity to a weaker dollar.
Okay. The other question is on flows. I was reading the Greed and Fear note last week, the one that came out or the one before that, wherein you cited at the Asia Forum your experience about how people are tactically, for example, constructive on China, while long-term they might be constructive on India. And you also mentioned about how there is an emergence of ex-China dedicated flows as well coming in. Could you piece this for us together? How would flows versus the appetite for the tactical uptick mean in the near term and then over the long term?
Well, it's now basically it's now widely understood, I believe, that India is a better long-term structural story than China. That's really always been my view, but that's virtually everybody's view. So, and obviously that's in large part, there's lots of reasons for it, but one obviously key reason is demographics. However, China is a very big part of the emerging market Asian benchmarks. Now, given all the political issues between US and China, given the precedent of Russia's stock market being suddenly essentially cancelled and basically removed from the MSCI index, many global emerging market funds or managers are at the back of their mind, there's a small but not zero risk that this could happen with China. because this incident happened with Russia with very little notice. So if you were a global emerging market fund, let's say you had 10% of your fund in Russian equities, which some did actually, then suddenly you're forced to write these stocks down to zero, although they're still trading in Russia, and Russia's kicked out of the benchmark. So there is for people worried about this, and also don't think China's as attractive a story. They don't like the size of China in the benchmark. Yeah, there's a growing interest in what is being called global emerging market ex-China mandates. And so in many ways, a good approach would be to do that mandate, and then for people who want to invest in China, you have a separate mandate. So I'm not saying this is starting to happen, but this is the discussion. Meanwhile, global money has stopped investing in China. Money not dedicated emerging market money, global money which doesn't need to invest in China because China's only a small part of the global index. So that global money does have the potential to come to India. But I would say by and large, most FII money in India today remains dedicated Asian and emerging market money.
Got it. How does this tie in with the argument around India being an attractive market but being a bit expensive? Because that's the common thing that we hear all these years.
That's the common theme. So obviously the track record is that it's paid up to pay for quality in India. So structurally, I continue to view India as the most attractive market globally, and very certainly most attractive market in the emerging market context. Right now, the big caps in India, in my view, are not crazily expensive. Actually, they're at kind of mean valuations. Obviously, the noise here in India this week is that the mid caps are clearly at the expensive range, and that's
you wrote about that.
Yeah, but I'm hearing that more and more. But that I think reflects the practical reality of huge flows into the mutual funds. But you see, this very dynamic mutual fund industry in India is actually just a big long-term positive, because I think it was well demonstrated in the last 18 months during the RBI tightening cycle. So I came here in early 22 for the first time before the pandemic, and most of my colleagues were very cautious on the Indian stock market, because at that point in early 22, it was at peak valuations, and the RBI was a bit behind the curve and was just commencing a monetary tightening cycle. But the stock market throughout the course of that monetary tightening cycle turned out to be extremely resilient. And I think the key reason for that resilience was domestic flows. So actually what happened in reality is the earnings growth caught up with the valuations. And so actually the foreigners never got the opportunity to buy India at lower levels they were hoping for. So while everybody is bullish on India right now, the reality is, based on the data we've got, they don't appear to be that overweight India. When I say they, the foreigners.
Yeah, I get the drift. Okay. Just one small technical question before I ask some fundamental ones. At the period of time pre-March this year, for that 6-month period when there was a large FI selling, the fact that they were able to exit what they wanted to without too much of damage on the tape, without too much of damage on the pricing? Because has that gotten noticed? Because a lot of people here believe that that must have been a standout feature from an Indian market perspective as well.
Well, it's quite clear that domestic institutions are more and more important in the Indian market. And by the way, that's a trend we see elsewhere in many countries in Asia, but India is probably the most dramatic example. Because the foreigners, you see, had to sell India suddenly because China suddenly reopened.
Yes.
And we had a period of a few weeks where China literally outperformed India, I believe, by 30 percentage points.
Yes.
And in that period, China basically went from 8 times earnings to 12 times earnings.
And then boom, a bit of a sell-off again.
Yes.
Could that happen again, Chris? That if China gives a large stimulus?
But by the way, my base case is China's not going to do a large stimulus.
Okay.
Because that's not what President Xi believes in. But I mean, we can't write off that possibility completely, because he may get out of bed tomorrow and decide different. But my base case, no large stimulus. So we could have a bit of China outperformance if the property market starts to really show clear signs of stabilization. That's entirely possible. I don't think it will be on the scale of what we had in when they suddenly reopened.
Sure. Okay. Get the drift. You made a reference about India's surprising relationships with some of the other blocs. You would have noticed the India, UAE, Europe, US corridor as well. What has stood out in this geopolitical alignments that India has made? What has impressed you the most?
Well, yeah. So I was in Delhi earlier this week. I arrived in Delhi just after the conclusion of the summit, and as I wrote in the Greed and Fear, yes, India seems to have been in a very strong position to have a basic. India now has a foot in both camps.
Yeah, that was the title. Yes.
Yes, which I think is a very smart place for the Indian government to be. And what's clearly got what's made people sit up on this G20 summit is that the communique on Ukraine is incredibly diluted from what was written at the Bali summit, but obviously everybody signed it. So this is obviously viewed as a triumph for the Indian Prime Minister. And the very fact that they were willing to dilute it so much, when I say they, the G7, really shows you how much they want to have the Indian government on side. Because it's become clear since this whole Ukraine thing happened that, for want of a better term, because I don't really like it, but the global south has a much more nuanced view of this Ukraine conflict than what you hear coming out of Washington, Brussels, or London. And then I think this project, MIPAC, what do they call it? The Middle East link, the project to link in Indian subcontinent, Middle East, and Europe is clearly looks like a counterweight to the Chinese BRI.
Yeah, sure.
So these are very, very dramatic developments. But if you think about it, also you have the BRICS formation, which got a lot of publicity. Now Saudi and UAE and some others have been invited to join BRICS. So the question is, are they actually going to join? Everybody's assuming they're going to join. So if they are joining, that's more than 40% of world exports, oil exports, in the BRICS. So that gives the BRICS actually huge power, unless you believe everybody's going to stop using oil in the next 2 years. But if I'm India, I'd rather be in the BRICS than not in it, right?
That's true.
So that's my point. I think India is very well positioned in that context.
And you reckon large global investors are now starting to realize this importance of the geopolitics from an investing perspective as well?
Oh, well, no, they have to be, because the geopolitics has got quite intense, because the US has effectively declared economic war against China with its move to deprive China of access to advanced semiconductors. That's squeezing China where it hurts.
Yeah. Okay. Now, Chris, last 3-4 questions while you sip on your coffee as well. Everyone builds a hypothesis about a place or a market, and then they either tend to get surprised positively or maybe slightly negatively. In your hypothesis for India, because you are constructive India, as I can see from all the notes that you've written, is this a base case bullishness that you have, or are you baking in some bit of optimism above what is your base case when it comes to the India hypothesis?
Well, what's been very encouraging, I'm just talking specifically India now, what's very encouraging the last 3 months in India is we have seen growing anecdotal evidence that finally we're getting more evidence of beginning of a private sector Capex cycle. when I'm talking in the sort of cap goods area. So we're now into our 3rd year of the residential property recovery, which is extremely important because that's got all kinds of multiplier consequences for the economy. That's after a 7-year residential property downturn. So I've been hoping that the residential property recovery would lead with a lag to a more pickup in private sector capex, which is also what happened in the 2002-2009 cycle. And we're beginning to see the evidence of that in terms of increased order flows. But actually the best evidence is market evidence. The stocks geared to capital goods have been rallying hard. So to me, that's actually the best evidence. Although obviously if you're a government official in Delhi, that might not be to you the best evidence. But the difference between 2002 and 2009, we've already had a big capex cycle in India from the government.
Yes.
because most of these fiscal deficits, the fiscal deficit looks very high, headline number, but it's not as bad as it looks, in my view, because a large part of that fiscal deficit is been driving these its infrastructure build-up, which has to have huge multiplier consequences, proven efficiencies for the economy at large, just as was the case in China with their huge infrastructure build-up. Whereas in the US, just to take the example, the US fiscal deficit right now is running at more than 8% of GDP, which is not so far off the levels it got in the global financial crisis, but it's not been driven by big infrastructure build-up like the Indian one was. So I think the most hopeful thing here in India right now is the private sector Capex, showing signs of life.
Yeah, and from past cycles or from the assessment that Mahesh and team would be making, you reckon that the baton has been passed and private sector Capex will come to the fore now?
Well, no, Mahesh, we think it's being passed, starting to be passed. But that would be good news for the government, you see, because the government would like to see that, because they've been making all the running. They'd like to see the private sector kick in a bit, then they can ease off on the fiscal side, because obviously they've got. Right now, if I'm in the Indian government, I've got this oil price rising. I've got this election next year. So when oil was at 70, they probably had more room to adjust things ahead of the election than if oil was at 90. So yeah, that would be a very healthy development. But we've been of the view that we've been hoping for a repeat of the 2002-2009 cycle. Sure. In the sense that the real estate market picked up first, then it was followed by private sector Capex, and India actually enjoyed its best outperformance in the Asian context during that period. And obviously the banking system's cleaned up, the corporates are very underleveraged, but there's going to be a bit of sitting on the sidelines ahead of the election, although everybody's assuming the election's going one way.
That's true. That's true. And I was going to come to that as well. But just before that, just the point on this private sector Capex and real estate cycle, because it helps that the private sector Capex would be coming at a point of time when the real estate cycle is running concurrently, right?
Yeah,
you were amongst the earliest identifiers of this.
Absolutely. No, the real estate cycle's full underway. Now, if there's a problem with the real estate cycle, it seems to me that it's being very much led by the high end.
Yes.
But that's not a problem, but that could become a problem. But actually, normally, in the sense you want to see a broadening out, right? But normally when these property cycles start, they normally start in the biggest cities and they normally start with the high end. So, but the interesting point is it's remained remarkably resilient in the face of rising rates. And that's because we had a 7-year downturn. And so for 7 years, basically, nominal income growth exceeded property prices.
Yeah.
So I continue, although they've already gone up a lot, and they could well correct, if the oil goes up here, the property stocks, actually, the biggest and most successful developers are benefiting from huge consolidation in the industry because of all the body blows the industry took.
Yeah. And which explains the 8% weightage that you have on the Indian real estate companies in your Asia ex-Japan long-only portfolio. It's circa 8% if I'm not wrong.
Yeah, but my Indian portfolio is like double that.
Yeah, sure. Okay. Elections, you mentioned, Chris. Assuming that the outcome is what the market expects or wants it to be, do you reckon that some bit of global money or a large bit of global money might also be waiting for that outcome to be behind before they commit large sums of capital, FDI or FII money?
Yeah, and I think they're already beginning to commit money, but on the portfolio side, there's a huge potential for global investors to increase their exposure to Indian equities because, as I say, they've exited China. There's a technical issue there that a lot of these global funds might not have FII because it's not like, unlike if you want to invest in China and you're a global investor, there's all these ADRs. It's not the case in India.
True.
So there's a technical, but in my own global fund, I think I have a 15% exposure to India. That's 14 percentage points more than most global funds. There'll be global funds that have no exposure to Indian equities.
Yeah, but
So on the FDI front, clearly the PLI scheme, the need for people to move production out of China, that there was a cost issue in China, but companies like Apple's the best example, basically didn't want to move from China because China is an extremely efficient place to operate. They've got all the logistics in place. They've also got the big domestic market. But all these US companies, big commitments to China, even if they wanted to stay 100% in China, they can't take that risk anymore. For the same reason the portfolio investors can't, because there's a they could be ordered to leave China by the US Congress. Yeah. This is a risk so this is a huge opportunity for India. So basically, if people are looking for to move production to somewhere else in Asia, the obvious competition to India, I would say 3 countries, Vietnam, Malaysia, Thailand. But India's got one huge advantage over these other competition. India's got this big domestic market. So actually, I think as a practical matter, India only needs to be 70% as good on the offering to get this business. So, and it's just a question of tweaking the PLI schemes, to make sure they have they're designed right to attract the investment. So this is a huge opportunity for India.
Okay, let's see how it goes. Now, my last question before I do a rapid fire, and my last question is: so therefore, would it be safe to say that your hypothesis currently is a base case hypothesis, and there is a room for a positive surprise in your optimism that you've built in?
Oh, no, absolutely, yeah.
Okay, great. Last 5 questions, a bit of a rapid fire for you, Chris. 30 seconds for an answer if we can. I've chosen these topics randomly as I deemed fit. So, US versus China, the one which will have a bigger impact on the world by the end of this decade. And why?
On world financial markets.
Or growth, or geopolitics, US or China?
Oh, US.
US, okay. AI has been the buzzword of 2023. You reckon it's an enabler, or do you reckon it's a disruptor of businesses?
No, short-term disruptor, but long-term enabler.
Okay. Rate cuts by the Fed and then maybe it's other central banks, early 2024 or late 2024?
Oh, good career. Maybe early.
Maybe early.
Maybe mid.
Yeah. Okay. A lot of people like Japan in the Asian context as well. So if I were to omit China versus India as a conversation, as a long-term bet, Japan or India?
No, actually, they're complementary. I would right now I would own both. Japan is interesting because big pressure for Japanese corporates to improve ROE.
Okay.
Coming from Tokyo Stock Exchange, otherwise they risk being delisted. So this actually is a real pressure point.
Okay. I know you don't make very short-term calls, but I'm forced to ask you a tactical call for the next 3-4 months: Indian markets or Chinese markets? Tactical.
Oh no, that'd be that's. I haven't got a strong view on that one.
Okay, never mind.
50-50.
Okay, you have very large weightage on Indian property all this while. You've upped the weightage on India internet as well. Between the two, India property or India internet, the better bet?
For what period?
Let's say 12 months or 24 months.
12 months maybe still property. Longer the time horizon, the internet.
Okay.
Yeah.
And from all the things that you look at, if I were to ask you to predict a dark horse for 2024, it could be a market, it could be a theme, it could be a set of companies. A dark horse for 2024, something that you think the market is not quite pricing in.
No, in a world where we suddenly get the Fed cutting rates, then you'll get and especially if that coincides with dollar weakness and growing focus on the fiscal issue, then you could get a move in gold, but you need the Fed cutting rates.
Okay. Chris Wood, this was such a delight talking to you. Thank you for taking the time out and being with us on Worldview.
Thank you.
And viewers, thanks for tuning in.